Hello everyone! Today I want to talk about an international accounting article titled A Review of Financial Accounting Fraud Detection Based on Data Mining Techniques. This article talks about how technology can help accountants and auditors detect fraud in financial statements. Nowadays, financial fraud has become a very serious problem in many companies around the world. Some companies manipulate their financial reports to make their business look healthier or more profitable than the real condition. Because of that, investor and the public can be fooled by fake financial information. In the abstract, the research explained that fraud cases keep increasing, while traditional auditing methods are sometimes not strong enough to detect modern fraud. That is why companies need more advanced system and technology to help identify suspicious activities. The article focuses on the use of data mining techniques. Data mining is basically a technology that can analyze huge amount of data and find hidden patterns automatically. So instead of auditors checking everything manually one by one, the system can help detect unusual financial activities faster. The article reviews many previous studies related to fraud detection methods. Some methods discussed in the article are logistic regression, Bayesian belief networks, decision trees, fuzzy logic, and genetic algorithms. Even though the names sound complicated, the main idea is actually simple. These technologies are used to help identify whether financial data look normal or suspicious. At the end of the abstract, the researchers conclude that data mining technology can improve fraud detection, accuracy, and help auditors work more efficiently. In simple words, this article explains that technology and artificial intelligence can help accountants detect fraud faster and better than traditional method alone. Now, I want to explain why this research is important. This research is important because a financial fraud can cause huge problems. When a company manipulates its financial statements, investors may think the company is successful even though the real condition is bad. As a result, investors can lose money, employees can lose jobs, companies can go bankrupt, and public trust can disappear. The article mentioned famous fraud scandals such as Enron, WorldCom, and Satyam. These cases become famous because the companies manipulate financial reports for years before the fraud was finally discovered. For example, Enron hid company debt and made profits look much higher than the real condition. In the end, the company collapsed and caused huge loss. These scandals prove that traditional auditing systems sometimes fail to detect fraud. Another reason why this research is important is because companies today produce huge amounts of financial data every day. Large companies have thousands of transactions, financial reports, payroll system, tax records, and accounting documents. It is impossible for auditors to check everything manually in a short time. That is why technology become very important. Data mining system can analyze data quickly, identify suspicious transaction, detect unusual financial behavior, and reduce human error. This article also shows that accounting today is closely related to technology. In the past, accounting was mostly about bookkeeping and calculating numbers manually. But now, accounting also involves digital system, artificial intelligence, data analysis, and fraud detection technology. So, modern accountants not only need accounting knowledge but also technological skills. Next, I want to explain the theoretical framework of the article. The article is based on data mining theory, fraud detection theory, and forensic accounting concepts. The researchers explain several techniques used in fraud detection. The first one is classification. Classification is used to separate data into categories such as fraudulent or not or non-fraudulent. Basically, the system tries to predict whether financial data looks suspicious or not. The second technique is clustering. Clustering groups similar data together. If there is financial data that looks very different from others, the system may identify it as suspicious. The next technique is prediction. Prediction methods are used to estimate the possibility of fraud happening in the future based on previous financial data. Another technique is outlier detection. Outlier detection identifies unusual or abnormal financial behavior. For example, unusually high expense, especially as revenue increase, or strange accounting transaction. The article explains that this method is very useful because fraudulent transactions are usually different from normal transaction. Then there is regression. Regression techniques analyze relationship between financial variables and estimate fraud risks. One common method discussed in the article is logistic regression because it is considered accurate and easy to use. The last technique is visualization. Visualization presents financial data in cards or visual forms. This makes it easier for auditors to identify anomalies and suspicious patterns. Overall, the article shows that modern fraud detection depends heavily on technology and intelligence system. Now, I will explain the research method, participant, and analyze and result. The researchers use a literature review method. This means they didn't do surveys or interview directly. Instead, they collected and reviewed many previous studies related to accounting fraud detection and data mining. The studies review were published between 1992 and 2011. Because this is a review article, there were no direct participants like students or employees. The participants were actually previous studies and data used by earlier researchers. The review studies include fraudulent companies, non-fraudulent companies, auditors, banking data, insurance claims, and financial statements. The researchers compared many fraud detection methods such as logistic regression, neural networks, Bayesian belief networks, Bayesian logic, and genetic algorithms. The result showed that logistic regression is one of the most commonly used methods because it has high accuracy and is relatively easy to understand. The study also found that neural networks are very powerful for identifying complicated fraud patterns. Neural networks can learn from previous fraud cases and improve over time. However, the article explained that neural networks are sometimes difficult to interpret because the system processes are not always easy to understand. The articles also explained that Bayesian belief networks show very good performance in fraud classification. Another important result is that outlier detection still needs more research because detection abnormal financial behavior is difficult. The researchers also mentioned one major challenge in fraud detection research, which is the lack of valuable fraud data. Many companies keep fraud cases confidential, so researchers often have difficult obtaining high quality data. Overall, the article concludes that data mining techniques can significantly improve fraud detection system and help auditors work more efficiently. Okay, finally, I want to explain the conclusion of the article. In conclusion, this article explained that financial accounting fraud is a serious global issue. Yes. Traditional auditing methods alone are not longer enough because fraud techniques are becoming more advanced and financial data is increasing rapidly. The article shows that technologies such as logistic regression, neural networks, Bayesian belief networks, fuzzy logic, and detection trees can help improve fraud detection accuracy. The article also proves that technology and artificial intelligence now play very important roles in accounting and auditing. Modern accountants and auditors need both accounting skills and technological skill. Overall, the article is very useful because it explains how accountants, technology, and artificial intelligence can work together to prevent financial fraud. The research is beneficial for auditors, accountants, companies, investors, and researchers. At the end, the articles remind us that transparency, accountability, and technological innovation are very important in modern business and accounting system. Okay, that's all from me. Thank you.